Hello and welcome to Charting the Markets. It's Monday the 13th of March, and in a week that is expected to be dominated by US inflation, instead we're seeing widespread selling as we see the fallout continue from the collapse of the Silicon Valley Bank. That, of course, raises fears of a potential widespread bank run within the financial sector as a whole. We have seen moves to quell that, certainly over in the US, saying that they're trying to protect deposits. In the UK, the UK arm of the SVB has been bought by HSBC, and initially that was enough. I mean, markets were actually up in early trade. It's not lasted though. We've seen by and large European markets around about 2% and some lower. And there's question marks about where we go from here, really. So certainly this is going to be a particularly interesting start to a week that already has volatility pretty much factored into it, because tomorrow we have the UK jobs report. We've got the US CPI coming out tomorrow, which is going to be absolutely massive. The budget on Wednesday in the UK. We've got PPI and retail sales out of the US on that day as well. We've got Australian employment data coming out on Thursday, the ECB rate decision on Thursday. I mean, look, it is a jam-packed week. So to throw into that a massive potential crisis in the banking sector is something that really does keep you on your toes as a trader. So let's really try and pick apart how the charts are looking at the moment and see exactly how things lie from a trading perspective. Looking at the indices front, we can see the likes of the FTSE 100 sharply lower. This comes after a relatively stable start to the trading day, but certainly this does, for me, pave the way for a potential period of weakness. This weekly time frame shows you the wider trend we're dealing with. The wider trend is bullish. Since the lows that we saw here in the sort of height of the pandemic collapse, we have been creating these higher lows. Now, that means that the level we're looking out for here is the key level is going to be this one down here, 67.04. And so as we move into the daily time frame, what we can see here is that we've got this bullish trend negated with that breakdown below. Let me just get rid of this line and move into this one, 77.07. So with the fact that we've broken the 77.07 mark, it means that this trend is over. Now we need to ascertain, what are we retracing? Are we retracing this? Is this the dominant move and this is just a small portion of that leg? Or is this the same as this? So are we retracing this move, or are we retracing the wider move? As things stand, let's see exactly where we lie within this. We've moved tentatively beyond that 61.8 Fibonacci level at the moment, finding a little bit of support. So certainly whether we respect this zone of support or not is going to be particularly interesting as we try to ascertain whether we're retracing this wider move or that nearer term move. I'm just going to draw on that wider one. So we can see, let me just get rid of this swing high from here. There we go. So we can see that this wider retracement would call for a potential move into 70.20, 72.15. But until that happens, there is certainly, I would say, a good chance that what we're seeing here, because this is a relatively swift pullback, this is a more notable pullback, you know, we could be retracing this wider move. So how we hold up in this zone is going to be very important. In terms of the short-term price action, you can see that collapse. You know, ultimately, this comes off the back of a gap higher as we opened the new trading week, and we heard that news pre-market of HSBC taking over the assets of the SVP over in the UK. Nonetheless, it did not hold, and we've seen a sharp capitulation for this market. So it's very difficult to say, you know, oh, if we rebound through this swing high, because we're so far away from it, because the nearest swing high is this level here, set this morning at 77.56. So near term, we're seeing a bit of upside. I still think that this is a very risky one for us to be buying into right now, because in a way, we don't necessarily know whether, you know, if we put our stop losses below 72.96 and looks for longs here on a wider perspective, we don't necessarily know if we're retracing this move or we're retracing the wider move here. So certainly I'm a little bit hesitant on this one. I want to see how it plays out, see how it respects this 61.8. Do we continue to move through? Do we respect the 76.4? Probably makes sense to be looking out for how this settles. There's a possibility we could find some support, form some sort of base around here, potentially create something like a double bottom, something to trade around. But at the moment, I'm a little bit hesitant on this market that clearly is in the midst of a very sharp and reactive move. Now we're looking at the DAX, and this is another interesting one because whilst we're looking at 61.8, which, you know, Fibonacci levels are great and everything, but they don't really tally up in the same way as this level here. 149.03 is the swing low that we're seeing here established in late January. Now we've dropped down into that level. What we're saying here is if we break below that level, then we're looking for a retracement of this wider move. If I get the fib on, we'll be looking at a retracement of this rally from 136.96 up to 157.05. So that 49.03 really underpins that move. If we break that level, then it's a good chance we drop to the 144.63, potentially extended down to 141.70. But certainly, if we break that level, it does point towards the potential for another, say, 400 points towards the downside if that happens. But certainly, the trend is bullish. It still is bullish. We've seen the rebound, the pullback, the rebound. We haven't seen much of a pullback for a while now. So you could say this is due some sort of retracement of this wider rally. That's what's happening at the moment. So 149.03 is the key line in the sand. Like I said, with the FTSE 100, it's a risky one, but I would say this one doesn't look as risky. If you're looking from a risk to reward perspective, you could say, well, 150 points towards the downside, 150 points towards the upsides up here. So we could quite easily rebound for a 1-for-1. But you're looking at highly liquid situation, a highly volatile market. So it's a dangerous one. But certainly with that sharp decline, at some point, we're likely to see a relatively sharp and sizable rebound. We don't necessarily know that's going to come now, but the fact that we have respected that 149.03 does point towards the possibility that this could be the low of the day. You're already down 2.5% at the moment. So are we going to see 3-4% decline today? I just don't know, quite frankly. And there are measures coming into place to try and limit the outcome of this crisis. And also bear in mind, this is not the same as what happened in terms of the global financial crisis crash in the past, where all the banks were in big trouble and we saw contagion throughout the industry. I don't necessarily think this is the same. We're talking about one bank that took decisions where they didn't necessarily hedge their positions enough, and that has got them into trouble. So anyway, how we respond to 149.03 is going to be really key here, because as long as we don't break that level, we've got that long lower shadow, we could start to base a little bit here. We could rebound a little bit, even if that was a precursor to us selling off once again. But certainly that level is going to be really critical going forward. In terms of the NASDAQ, let's just get the US Tech 100. It's been holding up relatively well. You can see that once again, we're finding support on this 11817. That is the low that we saw back in 31st of January into the 2nd of March. And now once again, we saw it playing out on Friday. We saw that gap higher, but we're selling into it once again. So we're around about that support level. If we break 11816, it points towards a more protracted move towards the downside. Let me just zoom out. This is on the weekly time frame. There we go. So we've got this long-term ascending trend line coming into play down below. If we break through this area of support that we're currently at the moment, then there's a possibility of that wider retracement coming into play, as we see on the weekly time frame, the possibility of a wider retracement where that trend line can potentially come into play alongside Fibonacci levels. So that sort of zone down below looks interesting, but that's only if we break through support. At the moment, we're turning back down towards that level. So much like the FTSE 100 at its 61.8, much like the DAX at its key historical support level, we've also got a very important level here for the NASDAQ, which if broken would point towards a more protracted move towards the downside for this index. So certainly all three of these markets at really interesting support levels as we stand. Looking at the FX space, we are seeing widespread selling in equity markets. So are we going to see a big move higher in terms of the US dollar? Not necessarily. And this may allude to the fact that much of this crisis is centered around the US. So people aren't necessarily too comfortable with jumping into the US dollar as your sort of safe haven play. And we're going to turn to dollar yen in that regard. But starting off, we can see euro dollar. Let me just grab the sort of weekly time frame to give you that wider context. So long-term downtrend over much of the pandemic, certainly throughout 2021 into the first half of 2022. We've been regaining ground from there, but now more recently, rolling over in what looks like the beginning of another bearish phase. Certainly a breakdown through the support level 104.83 would give us greater confidence of that move. Until we do so, there's a possibility we could bottom here, and certainly the gains that we've been seeing at the moment do point towards a possibility of that. This is highlighted better on the daily time frame, the recent decline pulling back into that 100-day SMA, and now with the breakup through this resistance level around about here, you can see, let me just scoot it back a little bit here, you can see that we've got this little double bottom formation, which will be more evident on the 4-hour chart. So double bottom formation now completed. We're rolling over as we do see some US dollar strength coming into play. But certainly I think there's a good chance that we do see the bulls come back into play. It really depends on how long this sell-off lasts in terms of equity markets. We're seeing widespread selling at the moment, but I don't necessarily think it's going to last all that long. Look, who am I to say whether they're going to be able to really lock this down and make it into an event that only hits this one bank and soon enough everyone's back to normal. But I think there's a good chance that that's what's going to happen, because it's in the interests of the likes of the Federal Reserve. The UK government's already taken measures to step in to appease the markets. So do we see further downside? Potentially over the near term, but only with a breakdown through this 105.24 mark. Does it negate this double bottom formation and the potential for a rebound here? Bear in mind that 105.24 is just above that 104.83, which ultimately is the level that needs to break for this bullish trend to be over. Until that happens, we've come into a very deep retracement. We've flatlined on the bottom and now broken up through your 106.94. I think there's a good chance that even if we do see a near-term pullback, that we could ultimately be setting ourselves up for another move towards the upside for this market. In terms of cable, we're also seeing some upside coming into play here. There are some that are speculating that what's happening over in the US at the moment is likely to really tie the hands of the Federal Reserve and make them potentially rethink the possibility of a 50 basis point hike at their next meeting. Well, we have seen markets providing upside for cable as things stand with that gap higher. We're seeing a little bit of downside since that gap higher, but ultimately we're looking like we could break out towards the upside from this recent phase. You can see here we've got this sort of wedge formation here. Price breaking upwards, certainly greater confidence of a bullish resurgence back up towards your 124.46 would come with a break through 121.43. At the moment, we've tagged it and we're moving a little bit lower. So let's see exactly how this plays out. But like with euro dollar, there is a good chance that now that we've tagged that level, we do come into a bit of a pullback over the near term and see some dollar strength coming back into play for cable. So highly volatile one, but certainly a breakthrough 121.43 would provide us with a potentially bullish outlook for a market that more recently has been under pressure. And then I would say the most notable and interesting one of the lot is the US dollar against the Japanese yen. Now, ultimately, we're looking at a central bank that everyone was thinking, yep, the economy is looking great. Inflation is still a problem. It's sticky. We're going to see a potential 50 basis point move from the Federal Reserve. Meanwhile, Japan just sit on their hands. Inflation continues to move higher, but the Bank of Japan aren't doing anything about it. And therefore, we were looking at the potential for upside for this market. But that's starting to unravel now. We're seeing question marks around about how the Federal Reserve is going to act in the wake of what's happening at the moment with the Silicon Valley Bank. And that means that people are feeling a lot more confident about the Japanese yen as a haven over the US dollar. And we can see exactly that. The back end of last week, we did see some selling coming into play, and it's pushing on from here. The 4-hour chart highlights the end of that trend with the creation of lower lows on the breakdown through 135.33. And now since then, we can see that on the hourly time frame, we're seeing this sort of choppy but clear downtrend with the lower highs and lower lows rebounding a little bit here. Unless we see a break up through your 134.69, I think near-term gains are likely to be sold into once again. So more of the same expected until we see otherwise, which means a breakthrough 134.69 for dollar yen. Looking at the commodities space, it's a difficult one for precious metals because, look, quite frankly, markets, when they're selling off, generally benefit the US dollar. That comes to the detriment of the likes of gold, the likes of silver. And we have been seeing that of late. But then we're seeing that flipped because we're seeing equity markets selling off and the US dollar not necessarily doing too well because of the calls for what it could mean in terms of the Federal Reserves, because of the fact that this is a crisis centered around the US. And so actually we've seen precious metals doing relatively well at the back end of last week. Gold in particular, we can see rallied into 1890. That has been around about the high of the day today. And certainly if we look at recent price action, we would need to break the 1890 to point towards this pullback being over. We dropped down into your 61.8. We've now rallied up through your resistance level of 1858. That completes a double bottom formation, as we see here, and points towards the potential for further upside. Greater confidence comes with a breakthrough 1890, and we have tagged that and moved tentatively through that level. So certainly, if we continue to push higher and we push through that level, then it does point towards a continuation of that bullish trend that's lasted much of Q4, moving into the beginning of the year for 2023. So 1890 is going to be the key level, but it all comes down to whether we see the US dollar fare well or essentially come under pressure once again. So keep an eye out for that 1890 level. If we see that level broken, then it could point towards us seeing a more protracted move towards the upside. Until that happens, we've tagged this level. We're seeing stochastics rolling over. So certainly momentum waning a little bit. We're losing a little bit of that traction considering this sharp rally. There is a chance that we do reverse into this area, much like I was saying with the likes of the FX markets that are playing to the same kind of story here. So certainly we'd need to break the 1890 and sustain price action above that to give us confidence that we're going to continue that move that we've been seeing towards the upside of late. And then finally, looking at Brent crude, we're seeing a sharp decline at the beginning of trade today. We have seen plenty of chop recently. Certainly the rally up into 86.73 gave us pretty much flatlining highs. Now we've dropped down into 80.30. So look, we're talking about a symmetrical triangle where we're seeing lower highs, higher lows. That's now, well, it certainly appears to be reaching its climax, where this market's now moving into a range bound position. We're seeing flatlining lows, essentially flatlining highs, and therefore soon enough I think we're likely to see that break that gives us an idea of where we go from here. The weekly time frame would indicate it's a bearish break that's likely. The bearish trend that has been playing out over the course of much of the last year really does look like it's set for another leg lower. If you look at this pattern here, it looks like you're just going to see another move towards the downside to continue this same trend. But we haven't seen that break yet, and certainly greater confidence comes with a breakthrough 80.30. As things stand, we saw a bullish end to last week, that bullish engulfing. So that pointed towards a potential rebound towards the top end of this range. But certainly risk sentiment really taking a hit once again this morning, and that has led to this sharp decline. So 80.30 is the key level to look out for. If we break through that level, then it points towards a potential continuation of this recent decline and a potential for a protracted move lower for this market. But that's only if we do break the 80.30. Until that happens, you can see that we're in consolidation mode, and we still remain within that until we see otherwise. We haven't seen it yet. That raises the possibility of a rebound from this 80.30 zone once again for Brent crude. That's it for today. If you want any more news and analysis, make sure to go onto the IG platform. And that, follow me on Twitter. My name is Josh Mahoney here at IG. Have a great day. Good luck trading. Thank you.